to set up this basically as a few ground rules. But before I do that, Dave and I have been friends for a long time, probably close to 20 years, and we are just excited for you to be here. I'll get into more about Dave in just a couple of minutes, but let's see. We've got everybody muted, and before we get started, I'd like to just share with everybody that we're not CPAs, and we're not CFPs, certified financial planners, any of that. We can't give tax advice. So if you want tax advice after we've had this conversation, or down the road, if you have any further questions, they would be the ones to talk to. Dave and I are certified infinite banking practitioners. Some of you may know what that is. Some of you may not know what that is. And by the time you're done this evening, you'll have a better idea about what it is that we're talking about. You're sitting in a seat right now that I personally and my wife personally we're sitting in about 10 years ago or so. It was a pretty dynamic time in our life, and we kind of had this huge paradigm shift thanks to a friend of ours who shared this idea, this concept with us, and it really kind of rocked our world, blew our mind. And subsequently, going fast forward, here we are talking to you guys today. So you're kind of in the same seat as we were at that time, and it's kind of a revolutionary topic about finances and how money works. I'm going to record this, so down the road, if anybody wants to forward it to a friend or a colleague or wants to review what we went over, we'll put up a post where you can find it. I'm hoping that it's highly intriguing to you, and I really want everybody here to ask what questions that they have. Please feel free to write down your questions as we go forward. There's a chat box that you can see at the bottom of the screen. You can click on that and then type in your question. Make it real easy for us to kind of follow. If we see your question and it's relevant at the time we're talking, I'm gonna, Dave or I will pause and try to address the question right at that time, so we kind of keep that train of thought going, and it's not going to give you a hiccup further down the road when we're having further discussion. If we don't get to your question right away, it just means that we're going to get to it later, because it's probably going to be addressed as we continue our conversation, and that's my hope. And I promise you we won't miss anybody's questions, okay? Worst case scenario, we'll email you or we'll set up a phone call so we can have that conversation with you to make sure that all of it is addressed. Let's see. What else? Some of you are clients, some of you are friends, some of you are people we have not met yet. And I would say if you don't know us personally, just go connect with the person that referred you to this webinar tonight. We envision this being one of several over the course of the next couple of weeks, since we all are kind of captured at home right now. And we're looking for things to do. And, Dave and I were sitting back and we thought, man, it'd be great if we, why don't we just set up a couple of webinars and kind of share what we're doing, because people are out there and they're looking for things to do. And since you've got time on your hands, what better way than to learn about infinite banking and really how the financial system works? Because I'm going to guess that unless you've been around IBC or the infinite banking concept for a while, you have no idea how it works. You might have basic understanding, but this should be a lot of fun for you. Let's see what else. That's about it. So I met Dave, like I said, about 20 years ago, and we are both pilots. We met while flying at Northwest Airlines. Subsequently, the merger with Delta, the whole thing became a Delta Airlines operation, and We continue to be employed gainfully at this point. We don't know what's going to happen down the road, but I'll tell you this: there's significant reduction in the world in a lot of different areas, and the airlines are no different. I think that we're down below 20% of what we were flying. Dave, if I'm wrong, please correct me, but it is significant. And so, these are a lot. There's a lot of uncharted territory going on, and the times ahead are going to be interesting to see how everything unfolds. But I'm just going to go over a little bit of background of me and how I found infinite banking, and actually how it found me, and then just progress through the timeline and kind of develop uh, infinite banking, and talk about the current monetary system for you. Okay, so when I was just starting out of college, I was working for a defense contractor, and I just happened to be working on a classified program, and it was on some really cool uh, technology within the aviation industry. And one night I came home after a long day at work, and I turned on the TV to watch the news, and it was a local Dallas Fort Worth news, and they just happened to be talking about exactly what they thought I was doing out at the plant. They were talking about being a classified program, and we're working on this design of this new up and coming aircraft, and except the whole story was wrong. And I knew it was wrong, but probably 99% of the people out there didn't have a clue. It sounded so legit. And so I thought that was the first time in my life I had a paradigm shift of going and thinking to myself, what the heck am I just seeing here? What if that's not true, and I know it because I'm there, oh, so many hours a day, like, what about the rest of the time that they're talking on the news? I mean, what else there is not real? What's not true? And so I was like, that was the first time that I ever questioned what I was seeing on TV. And it really kind of threw me, and that has stuck with me all of these years. And now that President Trump has been talking about the fake news for years now, I mean, it just kind of brings home this whole thing about just what's real, right? So the stuff on the news is, you just really you got to look at a lot of different places to get the real story. And so as we were going through the 2000s, my wife and I started buying a lot of real estate. We've been big entrepreneurs our whole life, buying and selling, and just trying different things because we're just always wanting to be a little bit more financial savvy. And so about 2008, we went to this really interesting financial weekend. And from that, there are a lot of very smart people there in that room. And they were just telling us that there's something big coming. And this is in '08. And we got done with that weekend, and we're driving home. We thought, well, I guess we need to sell all of our real estate and liquidate all of our stocks, mutual funds, and 401ks, whatever we had. We thought, well, these guys are a lot smarter than we are, and so let's just do what they did. And guess what? We just went through that whole thing, and it was just like a speed bump. Hardly even phased us, and we were pretty excited about that. And so we're like, what's next in our life? And we began reading a lot about world economy, finances, gold, silver, and we're like, good grief, the government is starting to really create a lot of money. And the more money they started, creating, we thought, oh boy, the country's going to hit hyperinflation. I mean, it just makes sense, because a lot of other countries in the world that have gone through that money printing, so to speak, have gone through that. And we kept waiting and waiting and waiting, and nothing ever changed. It was always like the inflation factor was only, the reported inflation factor was always just a couple of percent. And so as we're going through time, we're like, where's the big, shoe drop on this deal? And it just never came. And then one day, we were sharing some really interesting books with another friend of ours, and he said, why don't you guys come on over and we'll spend the afternoon together, and I'll share something that I'm sure you haven't seen before. And so we did. And that was a day probably that we'll never forget, my wife and I'll never forget, because it completely transformed the way we saw the whole world, financially speaking. And that's where we were introduced to the infinite banking concept. And when he did that in such a way that it really kind of bothered us, and we finished that conversation, and we left his house, and we were just looking at each other all the way home, going, how do we not see this? And how come nobody ever shared this concept with us? Because it is everything that we want in a financial vehicle. We just never knew that it was there. And there's good reason for that when you really understand what the concept is. And so he started down the path like this with us. He asked us a couple really basic questions, like, you guys have a 401k or an IRA? And we said, yeah. And he goes, why? Well, to save for retirement, save for, down the road. And he goes, well, he said, can I ask you a few more questions? And we said, yeah. And one of them was, he goes, do you know what your tax basis will be when you retire? When you want to take the money out of your 401k? And I said, no. And he goes, well, let's just say that if you're a farmer and you had a seed of corn, and you planted that seed of corn. And at the end of the summer, it actually grew, and you had 2 ears of corn at the end of the summer. He said, now what's on those 2 ears of corn? There's about 600 seeds a piece. So that's 1,200. And he looked at us and he goes, if you're the farmer, would you rather pay tax on the seed or the harvest of that seed? The one seed or the 1,200 seeds, right? And we just looked at each other and we said, well, the one seed, of course. And then he just looks at us and goes, well, what are you doing with your 401k? Right? What are you doing with that? You're paying tax on the harvest, just the opposite of what you really want to do. It didn't even make any sense to us. It was like, what are the other options? And he goes, well, when you deposit your money into the 401k or IRA or a mutual fund or anything like that, for example, he goes, what's it look like tomorrow? And we said, we have no idea. It's a complete mystery. And he goes, well, what about 30 years from now when you want to retire? Or whatever that is, whatever number that is. And we're like, well, we have no idea. And he goes, so you don't know what it looks like, and you don't know what the consequence is as far as taxes go in the end, do you? I go, no, we don't know. He goes, well, how does that make you feel right about now? And I was like, well, you kind of see that idea, but you just kind of swallow it like bad cough syrup. You just take it because it's the only thing out there, right? When we sign up for things like that, especially our employers just slide a piece of paper across the desk and say, sign here if you want to join the 401k. You just do it. The thing they don't tell you is when you sign this, you're signing really up for something that you have no idea what it looks like tomorrow. In fact, you have a 100% chance of an unknown outcome. So it could be 100% loss. It could be 100% gain. You have no idea. But when you fully understand that the financial system is set up 100% against you, as we're going to discuss here in just a couple minutes, it's really going to give you that paradigm shift. And so the reason you haven't heard about the number one question I have as I'm going through with clients or with friends, the number one question they have is, why haven't I heard about this before, right? Why haven't I heard about this before? And the answer is, if you had a system that you had somebody else taking 100% of the risk and letting you earn money on their money 24/7, 365, as long as they could keep your money locked up in their system. Why would you ever tell anybody else? Right? That's amazing, except we all just line up like ducks in a row, and we all just sign up for that same system, and we're going to get the same outcome as everybody else, and that's a complete unknown at the end of the day. And it's just it really is just an amazing shift. And so what IBC represents is something that's just the opposite. It shifts the risk from us to another entity where they take 100% of the risk, and we get 100% control with 100% chance of winning, with no tax consequence in the gain at the end, with 100% uninterrupted compounding of every cent of principal, interest, and dividends that are deposited into the system. And it comes with a death benefit at the end. It's an amazing tool. And when you fully understand how it works, it will rock your world, because it's just the opposite of the system that is in place, where we're taking 100% of the risk. They're making money on our money, and we have no idea how it looks. And it's locked up in their system that that penalizes us if we need to liquidate it, or even it gives us really tight constraints and a maximum that we can even borrow while it's going forward for those 10, 20, 30, 40, 50 years, however long it is locked up before you are forced to take it out, or else they penalize you again on the back end, which is just crazy. And for the life of me, we have been a bunch of sheeple just lined up for the slaughter. It's like a casino. It's what your 401k and IRA are compared to what infinite banking is, where infinite banking gives you the ability to have full access to all of your available cash going forward in time. And it has every attribute you'd ever want in a financial vehicle, but you just never knew it existed. And so the answer to the number one question that I always get, so why haven't I heard about this before? The answer is the financial system through the bankers in Wall Street. I guess I would form it in a question. Why would they ever tell us about a system that took money away from them, where they couldn't use it? Because why would they ever want to risk any of their own money in the system when they can use ours to make money? And in the IBC system, we completely shed that risk. It's all gone, and it gives us everything we ever wanted from a financials perspective. So infinite banking really kind of gives us everything we've wanted. And we're set up now against a financial system, a money system. We'll call it the US dollar now. And we named this webinar the Fiat magic trick and IBC for a reason. And so let's just kind of shift a little bit away from how we store our money currently to how the financial world works. And I'm not telling you, Dave and I are going to give you a snapshot of how it works. We didn't make these rules up. They were made a long time ago. And so the US dollar, when it was a currency that had a connection to gold. And I don't know if you're familiar with that or not in the past, but in 1973, when Richard Nixon was the president, he uncoupled the dollar to gold. And at that time, the United States could only create as many dollars as they had in ounces of gold. Okay, and I have no idea what that number is. I don't, Dave. Do you know how many ounces of gold we had then? I don't. I don't think we do. But the government could only create as much money. So for every ounce of gold, they could create $32. Okay, so when Nixon severed the gold standard from the U.S. dollar, what that meant was that the U.S. dollar could be created without constraint. Thus, you can see on any yield curve the number of dollars that are actually being created all the way through today, and it's only accelerated through the 2000s and through up through current day, and it's just getting worse by the day. So, without that constraint, that's where my original concern was about hyperinflation and how that is all going to work. And so, Dave, would you like to expand a little bit on how the dollar is working today with the central banking system?
Well, yeah, you and I had this conversation earlier today. Oh, by the way, the magic of the Google, as my dad would say. When we went off the gold standard, as of today, we have 147 million ounces of gold in Fort Knox.
So they say, right?
So they say. Anyway, I couldn't look it up quick enough to see what it was in 72. But, like we were talking about today, and this goes into not infinite banking, but more worldwide fiat money issues, is it took 200 years to build up the first national debt of $1 trillion. And we just added how many trillion to it in the last 2 weeks? Seven, yeah. And the interesting thing about this is that how are we getting the money? They're just going to print it. The Federal Reserve is going to print money, and they're going to put it out into the system, and off it'll go. Now, we were talking about where is the inflation? Paul, you talked about that earlier. What happens to inflation? And I don't know if any of you people watch the dollar very closely, but dollar's 30% higher than it was 3 months ago. So basically, and then 60% of sovereign debt worldwide is in US dollars. So basically, anybody who has debt, and I talk about sovereign debt and large holdings of debt.
Just define sovereign.
Sovereign is country debt. Like the European Central Bank, 60% of their assets are in US dollars, and they're marked to market in US dollars. Same with Bank of Japan. Same with their Saudi royal family. They all deal in dollars because dollars have always been the standard of currency. As much as we love the euro fluctuates quite a bit more than the dollar. And if you're European central banker, you're sure as heck not going to put it in bolivars or even Chinese yuan. I mean, it just doesn't work that way. And so people who manage large portfolios of debt, and what we're talking about is people who are buying dollars. They're buying it through treasury bills, treasury bonds, whatever. They keep it in debt. They don't convert it to their own currencies. Since January, the dollar's up 30% on the average across the board against all other foreign currencies. Your dollars buy you 30% more euros than they did in January. Basically, what it did is it gave the Federal Reserve a cushion to print 30% more money and not really have any effect. And that's exactly what they did. And Paul, you were talking about
why is that?
What do you mean? Why is that?
Why is it that they can print just 30%?
Well, they can just do it. They're authorized to do it. They print the money. They float it out as debt, buying treasury bonds and treasury bills, and it flows it into the economy, keep the economy going. And they can just do that. That's their prerogative. They work with the U.S. Treasury. The Federal Reserve Bank is a private bank. They work with the U.S. Treasury to control the money supply. And they decided they're going to enrich the money supply. The crazy thing about this, and I don't want to get too deep in this because this will put everybody to sleep, and I get really nerdy about this stuff. But what I was talking to you about today is, okay, we just printed $7 trillion in the last 2 weeks. And now everything's supposed to go back to hunky-dory. Everybody gets their $1,200 check, blah, 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 blah. Well, and this has nothing to do with infinite banking other than, well, if they can just print money to pay off bills, why do we pay taxes? Why do they have to take our money if they could just print more money to make things keep working? And it's a question that will not be answered because it gets into a whole other realm of political things. But the point being is, we're in a really weird position right now because, like you said, Paul, when you sold all your stuff in 2008 and everything's going to crash, we're going to have hyperinflation, we're going to be Weimar Republic Germany in the late 20s and early 30s, and it never happened. We had quantitative easing, which had never happened before, where we print more money and there's more money flowing around. They kept inflation down. And here we are 12 years after the crash of 2008 in another crash, but it's a strange thing that we've never seen before with virtually no inflation. You're not going to see inflation either. I'm just going to go off on a tangent. Did any of you follow what oil did today?
Yeah.
Yeah.
Did
you see? Okay, so those of you who don't follow it too closely, some of the oil was priced at $11 a barrel today. And if you back it up through inflation, that goes back to the 1970s price of around $2.50 a barrel for oil. They have pumped so much oil in the last 3 months that there's no place left to put it. If you there are tankers just sitting there full of oil, waiting to offload, waiting for the price to go up a little so they won't lose money on their deliveries. The big thing that the oil contracts, the May oil contracts, which expire tomorrow, we're selling at negative $37 at 2 o'clock this afternoon, which means people who own the contracts, instead of selling them even to just break even or get a penny for them, we're paying buyers $37 per barrel to take it off their hands.
That's amazing, isn't it?
It's never happened before. And the reason is, and this goes really deep dive, and this has nothing to do with IBC again, it all goes to Cushing, Oklahoma. And the reason is all the oil that needs to be delivered in the United States gets, when the contract expires, if you're holding a futures contract for oil and it expires, you now have to take delivery of that oil. All the U.S. West Texas Intermediate crude contracts are delivered to the storage facility in Cushing, Oklahoma. But guess what? Cushing, Oklahoma has zero capacity to take any more oil. So you had a bunch of traders out there that are holding contracts that are supposed to expire tomorrow, and they had to get rid of them and roll them out to June contracts. Anyway, they had to get rid of them today because they can't take delivery of the oil because there's no place to put it. They would literally have tanker trucks showing up at their house saying, where do you want me to put your contract for 1,000 barrels of oil? And so they had to sell them at a huge, huge loss. Usually contracts sell down to the last minute. They'll sell for the price of whatever oil is trading at that day, less maybe a discount for time value. Okay, today that didn't happen. The lowest price of any oil on the world market was $11. The price of West Texas Intermediate crude May contracts was minus $37. And most of these traders trade on margin. And with commodities, it's sometimes up to 80, 90% margin. So what you're going to find out in the next few days when this shakes out is those who could not get rid of their contracts are going to be bankrupt. You're going to have a huge segment of the NYMEX and the Mercantile Exchange that are going to go bankrupt in the next 3 to 6 months, and maybe even tomorrow when this stuff starts clearing on Wednesday. It's going to be a bloodbath.
Dave, you took it down deep. That was amazing. I mean, that's way beyond the sphere of this whole conversation. But it all goes
back to, okay, and I'll bring it back because it was deep.
Yep.
Is the fact that you and I have been talking about this, Paul, for a long time. Paul and I flew together as captain and first officer almost 20 years ago. And we started having this conversation like I just went down the rat hole on for about a 4-day trip of what about this and what about this? And it all kind of came to a culmination during the airline bankruptcies of the mid 2000s when Delta and Northwest filed bankruptcy. And they came to us and said, hey, guess what? Remember that defined benefit pension that we promised you when you got hired 20 years ago and that you're going to get when you're 60 years old? We were just kidding about that. And you get to start over.
Not fun.
No. And so we got into this deep discussion. How do we remove ourselves from the system where I never, ever have to depend on a somewhat crooked third party who is really not looking out for my best interests to make sure that I'm going to get what was promised to me in the end.
Right.
And it led us to infinite banking. I actually came in the back door kind of through Pamela Yellen's book of I even forgot the title. What's her title for her book, Paul?
I don't remember.
I don't remember. But she was a disciple of Nelson Nash, and she wrote a book that copied all his ideas, and I read it 15 years ago and sat down and said, well, this makes sense. And there again, like all this stuff, when's the best time to do it? Well, it's 20 years ago. And when's the next best time? It's right now.
Yep.
But the point is it removes you from this system where we have no control. One of the big things of infinite banking is controlling your own money. And if you don't have control, someone else does. If your money's in a bank or you're using traditional banking methods, you need to finance everything in your life. You have, whether you pay cash or not, you pay cash, you are financing it because the cash, you're missing out on opportunity cost of something else that may come down the road. The trick is when you're financing it through third parties, there's a huge interest expense that goes to that third party and never returns to you. The whole idea of banking, infinite banking with a dividend paying mutual life insurance company like we do, is the fact that your money sits there and earns compounded interest, albeit a conservative amount, but that money is still available for you to go use it for other things.
So
and then
back out a little bit, because we kind of jumped ahead a little bit. But
thanks, Kathy. Bank on yourself. I forgot that. Yeah.
Well, there's just so much going on in your mind. I mean, that's frivolous for you, Dave. This guy is such a wealth of information.
It was an Audible book, so I never actually touched it. So there's no tactile remembering. So.
Well, let me just add on to what Dave was saying, and just take it back down to a little bit deeper.
Oh, you don't want me to go deeper?
Yes, I do, but not quite yet. I'm going to take the reins off in a second. You're just going to run with the thoroughbreds. It's going to be fun. But, we just have a lot of fun when we get together and start brainstorming and talking about things. But so let's just talk about fiat money, first of all, okay? In a real basic sense, there's only two ways that the government creates money. And this is really kind of an important thing to understand, you guys, because then it really helps you really appreciate what infinite banking is and how it works moving forward, okay? So like Dave represented earlier, the Federal Reserve works in concert with the Treasury of the United States, which quasi works in concert with Congress and the president ultimately. But the government has a budget, okay, each year, or they're supposed to have a budget. Sometimes they run for a couple of years without an actual budget, okay, but they should stay within the constraints of the budget. So getting back to how money is created, you go to the Fed, which is not a government agency. It is a private company, all right? And it's run by, for lack of better words, like a cartel of bankers inside of it, and it just expands into the banking system, so to speak. So that entity from day one, let's just roll it back when that first dollar was issued. Okay, so let's say dollar number one was issued, and the government says, how are we going to create money? And they made a contract with the Federal Reserve, which is a non-government entity. And so they said, well, we need $1. So they go to the Fed and they say, we want $1. And the Fed goes, okay, we'll create $1. And they let's just say they hand it over to the Treasury, and the Treasury says, well, how do we get it injected into the economy? Well, before that, the Fed says to the Treasury, hey, we're going to charge you interest for the production of that dollar. And we're going to say, let's just say that it's 5%. Okay. So if that dollar is out of the system for a year, let's just say that the Fed charges a nickel, the government, the Treasury owes the Fed a nickel. Okay. But now the Treasury has a problem. They say, how do we inject it into the economy? Well, the answer is they got to go find somebody to, let's just say, dig a ditch. And so how are they going to pay Fred to dig a ditch? They're going to say, Fred, we'll give you $1 to dig that ditch. And Fred goes, okay, that sounds like a good deal, but how do we get Fred to use the dollar, to take the dollar? Because for Fred, he doesn't know what he's going to do with it. So the government says, well, we're going to charge you a tax, and the only way you're going to be able to pay that tax is with this dollar or a fraction of it. So what that income tax does is forces Fred to use the denomination that the federal government issues through the Fed and the Treasury. So I hope that's clear. There's only one way that the government can make us use their money, and that's make us pay an income tax in their denomination. The only other reason the income tax is in place, you guys, is to either help accelerate or help slow down the economy. If inflation is running too high or too slow, there's really only two reasons to have an income tax on a federal level. The state level is different because they can't create money like the Fed can, like the government, like the federal government can. They've got to charge tax to be able to run and or be infused with money like they are today, like the Fed is just saying, cutting checks to everybody, individuals, states and that kind of thing. So getting back to originally how money is created, the Fed creates money. And today, I don't know what that number is from the 0 day to today, but what is it, Dave? About $27 trillion of actually created money that way. And then the only other way that money is created, and again, it's created out of thin air, and it used to be attached to gold. So now it's untethered, and they just create whatever they want based on a few things. If you went to a bank today and you wanted to buy a car, you go to the bank, you fill out the paperwork, your credit's okay. Bank says we'll cut you a check for the car. And how that bank creates that money is that they basically just type it into your account. It's a ledger entry into your checking or savings account. That money was not inside that bank that you're at. Okay, that is amazing. And as a side note, let me just say, if you deposited $1 in a bank today, okay, how much of that, my question to you would be, how much of that dollar can the bank lend out? Right? Dave knows. Stop it. Most people, almost everybody that I've ever talked to in a first time conversation, they always say, well, maybe 20, 30 cents, 40 cents, 50 cents. I mean, I've heard everything. The answer is it could be 10 or 20 times that dollar. Okay, and I know that makes no sense to most of you, but the up until about 3 weeks ago, every bank in the country had to have a reserve amount of money that they controlled. Okay, and so based on whatever that reserve amount was at any given time, the bank could multiply that and write out that many loans on that dollar. So what that's called is fractional reserve banking. And if you've never heard of that term, you don't feel like you're alone, because almost nobody knows or understands what that is. And so fractional reserve banking just is another way to create money out of thin air. And I just saw, I think in the last couple of weeks, the total denomination of monies that the US government has in place, if you include the 27 trillion that they've created through the Federal Reserve and then all the fractional reserve banking, Dave, correct me if I'm wrong, but it's $1,600 trillion. And I don't know what that number even looks like or how many zeros there are in that, but it's a huge number. And now, as Dave said earlier, we really, I mean, it's like we you would think that we had had a hyperinflation already based on that number. I mean, you just got to believe it. And here we are, Dave saying, and I totally agree, because of just what we see, creating another $20 billion before we even catch up to the rest of the world as far as all their fiat money, which is what this money is actually called, meaning it's not sound, it's unsound money because it's not connected to gold or any.
Not backed by anything other than the supposed strength of the economy of the government / country that's issuing.
Yeah, the government says that it's a dollar. Well, if you go back to 1913 to current day today, the dollar today can buy about a penny's worth of product compared to the dollar back then. And so, that's the amount of inflation we've got going on. And still we haven't even seen anything close to hyperinflation. So now you know that the fiat currency can be developed from two different entities. And what's really kind of interesting is that bank that created that money so you can go get the loan works like this. You get the check, you go buy the truck, for example. The guy who sold the truck to you is happy. You get the truck. The bank you borrowed the money from knows that you've signed a contract to give them principal and interest for the next, say, 4 years. I know that they've got some stupid 8-year loans going now, but let's just say it's 4 years. And so at the end of the day, at the end of the 4 years, the bank has the interest that they created out of thin air because you agreed to pay an interest rate between the time you started and the time you finished the loan. The bank zeroes out the ledger. They keep the difference, which is the interest. You get the truck. You're happy. The bank's happy. And they just make all kinds of money doing that. And that is a loss to you as far as the interest goes. Now, the guy who sold you the truck in the beginning takes that check, deposits it in his bank. Now, going back to what I was saying earlier, how much of that check can that bank now write additional loans for? And you can see how this can kind of just like blow up, right? And that's where we are with like $1,600 trillion of funny money, which is really what it is. So, now we're going to share with you why infinite banking is is the answer. And Dave, you want to describe what that is as far as what the product is and what houses the product and what it's within?
Sure, Paul. Those of you who are not familiar, infinite banking is basically using a dividend-paying whole life insurance policy that's issued through a mutual insurance company to basically warehouse your wealth. It's basically used as a warehouse, is the simplest way to put it. We always talk about Nelson Nash becoming your own banker, and we try to live by it when we talk about this, because basically instead of putting your money in the bank, where the bank then turns around and lends a multiple of your money out to other people, collects the interest, keeps the interest, and you basically get a pittance. I'm using not loans, but deposits now when you deposit into a bank. Current interest rates on even the best CDs are like 1% right now. If you think about it, the bank's paying you 1%. They have really no risk. They're going to lend out every dollar at 10 times that, so $10. They're collecting anywhere from 4 to 7% interest on that 10 times amount. Look at what the returns are. Getting back to infinite banking, you remove yourself from the system. What you do is basically you're putting your money into a entity and we'll call it your own warehouse. It's a life insurance policy. It resides in there. With a dividend paying whole life insurance policy, you get a interest rate on the cash value of your interest. Basically, specially designed life insurance contracts for infinite banking, what will happen is we try to load as much cash in the front end so the cash value of the policy is larger to begin with, starts collecting interest early on, has a death benefit that sits out there that also keeps you safe should anything happen to you. But what the magic of it is when you want to use your money, you then borrow it from the life insurance company. You're not borrowing it from the cash value of your policy. You're actually borrowing it from the pool of money that the mutual life insurance company has. It's a great loan for them because their collateral is your life insurance policy. If you can't pay it back, they're going to sit there and collect interest until you die. And then when they go to pay you your benefit, they're going to scrape out what you owe them from the loan. The magic of it is, though, is you're going to treat it just like a bank. You're going to take a loan out to do whatever you're doing now that you'd use a loan for in your day-to-day life, set up a plan to pay it back, and pay it back. The whole time you're doing that, you're paying the money back in to the general pool of the life insurance company. Your cash value, which is using as collateral, is sitting over here, and it's earning interest. When you take out the loan, it does not reduce it. It's just used as collateral. So what it basically happens is over time, that cash value grows and grows and compounds over the course of your life. The loans then are used just like a bank loan, other than the interest you're paying is going back into the pool of the life insurance company, who at the end of the year declares a dividend. That's the interest rate you get on your policies. Okay, the dividend goes back, adds to your cash value, buys a little bit more death benefit, and it grows and grows and grows. The trick with this is it's done with after-tax dollars. There's no government entity involved. It's a contract between you and a life insurance company. We've been doing this a long time. We pick the companies that are very, very stable, highly rated companies that have been in business usually for over 100 years and have declared dividends consistently for 100 plus years. So it's a very safe vehicle. It's not very exciting, but what it does is it takes the bank out of the equation and makes you the banker. Trick is, and what Paul and I always talk about is, once we get these things established, there's a lot of give and take like we're doing tonight to talk about how to make them work, what's the best practices, things like that. It takes a lot of responsibility on the part of the policyholders to manage it properly. It's kind of what we do as coaches, if there's an issue or a question, we answer the question. But what it is to really get us away from the fiat banking system and keep the money to ourselves. And when I say ourselves, I mean you and your family, and set it up right so there's generational wealth to pass on without a tax implication at the far end. How's that, Paul? Did I cover a little bit of it? Did I miss anything?
Oh, yes, that's great.
All right.
Yeah.
I don't want to keep everybody here all night because the problem is we laugh because when we're flying together, we have hours and hours talking. We'll spend 5 hours talking about this stuff.
So to expand a little bit on what Dave was just saying, okay,
Please do.
It really thanks. I want to help clarify a little bit because it's really hard to kind of swing over it. And I mean, I want people to be able to leave this conversation, and we promise we're going to try to wrap it up in the next 10 minutes or so. This will be, and again, I think we envision doing a couple more of these just to kind of expound on what infinite banking looks like exactly. But Dave mentioned that this whole infinite banking concept revolves around a life insurance company. And I know some of you are going, life insurance? What the heck? Why would life insurance be anything I'd want any part of? Right?
Special kind of life insurance, though.
Exactly. And if you're a Dave Ramsey fan or Susie Orman fan, they're like, stay away. You don't want life insurance. It's only there to, as a worst case scenario. And nothing could be truer, farther from the truth, you guys. there's, if you put an umbrella up, you've got all kinds of life insurance products in the system, and you'll understand there's two basic kinds. You've got permanent life insurance or whole life insurance, and then you've got term insurance. And between the two, there's a chasm of so many different types of policies. Typically, you've heard buy term and invest the rest, right? Invest what? In the stock market or in a 401k or a mutual fund or whatever that looks like, where again, you're taking 100% of the risk. And what we're trying to do, and eventually we'll show you, is that through the infinite banking concept, you're shifting the risk away from you with guarantees, full liquidity access, and oh, by the way, you've got a death benefit at the end. It is truly an amazing product. So putting the term product to the side, you've got a plethora of permanent types of insurance, whole life insurance. And we, within the infinite banking community, just work in this little splinter of a portion of that whole permanent or whole life policy type of insurance. And we deal with mutually owned, dividend paying whole life insurance companies, mutually owned, dividend paying whole life insurance companies, of which there are only about 20 in the United States. Only 20. And of those 20, we only work with a couple of those because they, well, for better or worse, they are dialed into exactly what IBC is all about. Okay. And the mentor that I had developed this whole concept about 40 years ago, and his name is Nelson Nash, although he did graduate from this earth about a year ago, and so he is with the Lord. But I had the real opportunity to spend about 8 years with this man, and we became and developed a great relationship, a great friendship with he and his family, and his kids. And I think he was 87 or 88 when he passed away last year. But that man really changed a lot of lives through the infinite banking concept. And I would share that, this is his first book. And if you haven't read it, I would highly recommend you get that book. And he was such a major player in this. And when I was first exposed to this by my friend almost 10 years ago, it took me a few months, but I went looking for Nelson. And eventually my wife and I flew down and met him. And we just had so much in common and instantly bonded and became friends. And then he pretty much, taught me everything I need to know. Not everything I need to know, but everything that he knew about infinite banking. Because I say that because every day I think I learn something new with infinite banking. And I know Dave does too, and every other practitioner who was schooled by Nelson and the Institute. So Dave and I are, we've gone through the whole infinite banking process. We are licensed and practicing practitioners within the infinite banking concept. And so working with those few companies, they have a product, and we have termed it a specially designed whole life insurance contract. It's a SDLIC, and every one of them is specifically tailored to the individual based on a set criteria. And that's a lot deeper conversation than we're going to go into tonight. But But what I do want to share is that there's a lot more to this conversation than can be possibly be had in 1 hour sitting. But really, if I could sum it up, if you could have a financial tool that you 100% owned, that compounded uninterrupted every cent that you deposited into its system for life, with 100% access to the cash value, and you had a death benefit at the end, my question to you would be, how much would you put into a system like that? that had tax-free growth and a yield curve that never inverts. And if you understand what a yield curve is, in Wall Street, you see up, down, up, down, up, down, up, down. You have no idea when you want to buy or when you want to sell because you don't know when it's low enough or when it's high enough. And you typically buy when you have the cash, and you typically sell when you need it. But anytime that you sell within that system, you're removing money from that system. And that money, once removed, is not working for you anymore. And you've got to pay a tax on it. Okay? Within the infinite banking concept, with a yield curve that never inverts, compounding your principal, interest, and dividends for life with a guarantee, with full access to liquidity, anytime you take the players in that other system right out of the picture. Because what you're doing is, instead of using some other entity to finance your life, you simply start using the infinite banking SDLIC concept. And so you start capturing all that interest that you're paying out. If you currently have debt, it's really easy to start capturing all of that back inside your infinite banking system and taking all that interest that would have otherwise gone out to somebody else. You're grabbing it and bringing it back into your system. And we have a system set up that in most cases, and I'm not saying all of them, but in many of the cases, you can capture all of your outside debt easily within 8 years and start seceding yourself from the system of finance as you know it today. So we're going to leave you with that. Dave, have you seen any questions that anybody might have? Or would you like to add?
Yeah, we had one question that my son's in the armed services. Could he purchase a policy to warehouse his money? Active duty armed forces are difficult, if not impossible, to insure through these insurers. They have to be out. And the second part of the question, David, was, would it be better for him to purchase the policy on me, his younger sister, or himself? His sister's life expectancy would be much longer than mine. Yes. Not to get too deep into it, but all insurance policies have an owner, a beneficiary, and an insured. You have to have a relationship, a blood relationship, or a family relationship to do it. But yeah, while he's in active duty, putting a policy on you or his sister would start the process. He would have full control of that policy. You'd have full ability to borrow loans from that. So yeah, and it's something you have to look at a little bit closer, but we can dig a little bit deeper into that. One other thing, Paul, what I wanted to talk about, you gave a great overview. You're much better at this than I am. I can just go deep dives on Cushing, Oklahoma, but you're better on the meat and potatoes of this. Is that part of the setting up of an infinite banking system does involve a deep dive on your family finances, your debt, where you want to be, and then setting up a structure and a plan basically to secede from the fiat money system over time. We've got calculators and planning tools that we use to do all this and set it up in a way that basically doesn't change your lifestyle a whole lot, other than you're warehousing your money in a different place than you currently are.
Right. And I would add to that, Dave, that infinite banking we're not saying that you shouldn't go out and use your money in other investment opportunities, because really we're not. And we could come across as saying that, but what we would like to share with you is that infinite banking is a foundational tool which everything else grows off of. It's just that simple. It's a real paradigm shift where I would tell you that my family and Dave's family, we run most of our money through our infinite banking system, our SDLICs, and then from there we use our money. And I'll tell you what, during an economy like what we're having, cash is king. If you have cash available, opportunity will find you. And I kind of equate this whole cash is king thing as being like an alligator in the water. The alligator's just sitting there waiting for the opportunity to come by, and when it does, and it will, it strikes every time. And the same thing with infinite banking. If you've got cash available, if it's not tied up in a 401k or in a mutual fund or in a stock, you can turn right around and use it. If you just have cash sitting, and let me just do a quick comparison. If you have cash sitting in a bank account, so to speak, and you go, I said cash was king, and you go buy a product, well, that cash is no longer working for you, right? You've got the product, but it's no longer working for you. But if you had your cash sitting in your own banking system in an SDLIC, infinite banking product, you could simply take that cash and go buy that same product, but you're not actually removing it from the system. And I know that's going to be hard for you to see in the beginning, but your cash will never stop working for you. And again, it goes back to that yield curve where it's constantly going up, no matter how much cash that you're using from the system to go finance your life. Okay. The conversation will continue. Hopefully, we'll see everybody next week. Dave and I would like to thank you guys all for joining us tonight, and we'll continue this adventure. Thanks again. And Dave, would you like to say anything else in closing?
Well, I want to thank you all for joining us. It helps us to sit down and talk about this because Paul gets tired of just talking to me all the time. I'm just kidding. Anyway, no, but what we want to do is there is so much to learn about this. We kind of gave a 35,000-foot view of how it all works, but there are little nuts and bolts and bits and pieces, and we've gotten a few questions. We had a couple of questions tonight, but what I envision us doing over the next few weeks and months is, besides taking the big picture, we'll take little chunks of the little picture. How do you take out a loan? What do you use it for? The whole idea, we talked about this as a foundation, it's a warehouse for your money. It doesn't just sit there. Your money just doesn't sit in the bank account. The alligator analogy is great. You want to sit there and use the money that you can borrow out of your policy for other income producing opportunities, or alleviating an income loss opportunity, like if you have to buy a car and you can use that. So we're going to work on that a little bit more as time goes on. And I'm sorry we've run over an hour, but we talked too much. But thank you for joining us tonight, everybody. I appreciate it.
All right. Have a good night.
Thanks, everybody.